Markets pivoting from DC back to Wall Street, and lo and behold, it's earnings season. While overall the majority of earnings have beat forecasts, companies are still struggling when it comes to revenue growth. And not surprisingly, with all the chaos down in DC, companies have been cautious in their outlooks. Thomson Reuters senior research analyst Greg Harrison.
They're trying to set a very low bar for the expectations out there, and there's not really a single factor they're pointing to. Most companies are saying it's just general weakness in the economy, general uncertainty about government policies, and so that's leading them to try and hold down their expectations.
Expectations are also low for getting an accurate read on the U.S. economy. Government agencies have to play catch up, and even when the data is released in the coming days and weeks, it will be murky at best. Decision Economics' Carrie Leahy.
Any number that's moderately weaker than expected for the next 6 weeks will be brushed off because it'll be tainted by the slowdown. And they'll say, well, just wait for the bounce backs.
The big one to watch, the jobs report on October 22nd. As for the Fed, after surprising the markets by not cutting back on bond buying in September, a move is now not expected until 2014.
You have to push it off for two reasons. One, you don't have a lot of information that's reliable. And secondly, what information you have probably tells you ought to nick down your growth forecast. And finally, you do not want to be a political football at this point in time, and particularly when you're making a change in regime from the chairman to the vice chairman.
He adds that the Fed will probably wait until their first press conference of 2014. That is on March 20th.
Commenters really focused on was